My name's Tony Saguibo. I'm with the National Labor Office, BlueCross BlueShield Association. I live and work in Portland, Oregon as an executive director for the Western region. I'm excited today to be joining you as part of the LIRA National Conference. I do want to first extend congratulations to both Emily and Bernadette for continuing to help make these sessions run smoothly. I've attended a number of sessions that have been incredibly well organized, so congratulations to you guys. I do have the distinct privilege to introduce our keynote featured speaker today, John Mitchell. I do want to just spend a little time introducing John properly, sharing a little bit about his background. John is with M&H Economic Consultants. He received his BA degree from Williams College and his MS and PhD degrees from University of Oregon. He was a chief economist of US Bancorp until July 1998 and served as Economist Western Region for US Bank until July of 2007. He wrote Sterling Bank's economic newsletter from 2007 to 2012. He was a business analyst for a local TV network for KPTV in Portland. He's been making economic presentations on the nation and the region for more than 47 years. During his spare time, and that he shared this morning that he's in Coeur d'Alene, Idaho, he enjoys biking, railroading, sea kayaking, and spending time with his grandparents. John, I've heard you before, and I'm so looking forward to your comments this morning. I'm going to turn it over to you.
Okay, thanks, Tony. I have to thank Bernadette for walking me through this process as we worked through it a couple of days ago. Well, I'm sorry we're not in Portland. The west side of the Northwest can be pretty nice in the spring. 7 months ago, when I was called, I had to put a title. I was asked to put a title on this, and it was Long, Shocked, and Inverted. That was in a different world. So I've now called it the Neutron Bomb Spring. So we can go to the slide. Okay, the neutron bomb spring. If you remember, a neutron bomb leaves the buildings but takes out the people. Okay, next slide. If you think back to January and February, this was going to be a pretty good year. Lowest unemployment rate, 50 years, rising incomes, tight labor markets, rising incomes, particularly at entry level and unskilled, diminishing prospects for inflation. You know, it looked like, hey, this is gonna be all right. We're gonna make it till the 12th year of the upturn. Now it's a very different world. It causes me to think about my favorite recession line, which comes from Copen Tan, who was a Barron's columnist, said this about 20 years ago. Like beer bellies and bald spots, it is very difficult to be precise about the onset of a recession until the evidence becomes overwhelming. Well, in a very short period of time, the evidence became overwhelming. We had the National Bureau, of course, make the call very quickly. Tremendous increase in initial unemployment claims, unemployment rate. You look at the Beige Book, economic activity declined in all districts. It's sort of, I think it's fair to say this is going to be the defining economic event of our lives. You know, it ripped apart our daily routines. There's a new book by Mervyn King and John Kay called Radical Uncertainty. And radical uncertainty is where you can't put a probability on it. It's from the unlikely, it encompasses that area from the unlikely to the unimaginable. I suspect in January of this year, none of us were thinking about the possibility of government-ordered shutdowns that would sort of bring the economy to a halt. But of course, that's our reality. Next one. Some of the numbers are so dramatic, and I suspect most people in this group have some familiarity, some are perhaps very familiar with them. But you look at the changes in payroll employment. We were sailing along with about $200,000 or 200,000 job a month gains. Then came March and in April, where we wiped out a decade's worth of job growth. And then very unexpected uptick in May of 2.5 2.5 million, but such a dramatic collapse in the labor market. Next slide. The change between March and April is incredible. Over 20 million jobs disappeared over the course of that month. You look at the detail, broad-based, basically all the sectors, dramatic declines in leisure and hospitality, as you'd expect with the closures. It was breathtaking in its magnitude. Then if you look at the next slide, April to May, a 2.5 million gain in employment. You had declines in the government sector and a few others, but a big uptick in leisure and hospitality as some areas had started to open up. But this was not expected, and as some said, this was the biggest miss that economists have ever had in terms of the magnitude of expecting what was going to happen in the labor market. And it might well be the bottom. We don't know. We'll have to see over the course of the next few months. If you think about that decline, think about what we saw. The next slide. Obviously, things like the lockdown, stay-in-place orders, travel bans, work from home, the closures of non-essential. And I don't know where you all are, other than where Tony is and Bernadette and Emily in Illinois, but an amazing patchwork of rules defining essential business and non-essential businesses. In the Northwest, you could build houses in Oregon, you couldn't in Washington, you could in Idaho. You couldn't fish in Washington, but you could fish in Oregon. You could go into a grocery store and buy furniture. You could go in grocery stores and buy furniture at like Fred Meyer, but you couldn't go into a furniture store. Just an amazing array of rules, and I'm sure you've all got stories. It's really demand and supply destruction by policy. The magnitude of what happened on the earnings side. I mean, April, you saw a big jump in average hourly earnings over the year and over the month, and they went down in May. We could say, gee, earnings went up, but what it was the disappearance of lower income jobs that, of course, boosted the average. Labor force bounced around, fell by 6.4 million in April, jumped by 1.7 million in May. There's very likely some mismeasurement of the unemployment rate. People who are employed but not at work, they were supposed to be counted as unemployed, but in the survey, they were probably counted as employed. The BLS says that might add 3% to the unemployment rate. People who are out of the labor force, they dropped out because of fear, sick, taking care of dependents. I mean, there's no question about the dramatic weakness that we've seen in the labor market. Okay, next. If you look at output, you all look at those numbers. And the point of this, the bottom was June of 2009. That was the trough. So the first full month of the upturn becomes July of 2009. And we basically have been growing ever since that point in time until you get the 5% decline in the first quarter of 2020. I don't have time to go into the detail, but the interesting thing, the swing, was in the consumption side, dramatic declines in consumption activity. Investment had been weak previously. A lot of it related to some of the trade disputes, that sort of thing. Okay, next. From an inflation standpoint, interesting. This is the April data. The May data came out a couple of days ago. And year over year, I mean, the May Consumer Price Index was down 0.1%. Year over year is down to 0.1%. And the core, which excludes food and energy, is at 1.2. So we don't have a headline inflation problem. You're all aware, of course, what's going on the energy side. Some interesting stuff in there. For example, the food area. We've seen rapid increases in the prices for food at home and relative weakness in food away from home, which is a reversal, dramatic reversal of what we've seen in recent years. But the whole structure of demand has changed. Okay, next. From an interest rate standpoint, and I'm assuming there's probably a fair number of economists on, a dramatic decline in this is the 10-year yield, now down to well under 1%. Very important because, of course, that 10-year is what mortgages are priced off of, but you've seen this incredible decline. Some of us are old enough to remember back in the early 80s when this rate was in the teens. Okay, now it's less than 1%. Next, what we've seen, some incredible monetary policy actions very, very quickly. The Fed funds rate was cut in March twice between meetings. The Fed has moved very aggressively, providing liquidity to keep the markets functioning. Things like, and obviously can't go through all the detail, but Main Street funding, commercial paper, providing liquidity for the Paycheck Protection Program, buying term asset-backed securities to support markets. I mean, dramatically increasing the size of their balance sheets. Well, unlike 2007, this didn't start as a financial issue. When you think about businesses with no revenues, people with reduced income, it can very quickly become a significant financial problem. The Fed reactivated a lot of stuff that it did back in 2007 and 2009. Those lessons were learned. It was incredible speed, and those two cuts in the funds rate, they were done, with telephone meetings. They weren't done with formal meetings of the Fed in Washington, D.C. The speed was remarkable. And we saw mortgage rates basically hit all-time lows. They're now just a touch over 3.25%. Remarkable level of interest rates. Next. We could look at fiscal policy. Of course, actions by Congress and the president. We've seen 4 coronavirus bills passed: Preparedness and Response Act, Families First, the CARES Act, which of course got lots of attention, Paycheck Protection in healthcare, a whole range of actions, stimulus checks, forgivable loans, boosting unemployment compensation, help to hospitals, states, cities, expanded sick leave, and very likely more to come. Now, it's interesting that if you watch fiscal policy, this happened for fiscal policy relatively quickly. We've had about $2.5 trillion in new spending. The intent here, try to preserve the firm employee-employer relationship to make sure the firms could survive to reopen. Obviously, there were some significant rollout difficulties and trying to get millions of loans out from an agency, the SBA, relatively small, that had not done this kind of volume. There's probably more to come. There very likely will be additional spending. It's interesting, we've seen dramatic expansions in monetary policy and fiscal policy. There was an article that appeared in Foreign Affairs last week by Sebastian Mallaby called "The Age of Magic Money." can endless spending prevent calamity? Well, we're going through that experiment right now. I mean, you don't hear a lot of people worrying about the deficit at the moment. Right. Next slide. I think you have to ask the question, are we hurtling toward the bottom? I think we are. This could be the bottom. It may well be that the second quarter might mark, the end of the decline in economic activity. When all is said and done, I mean, we may get an annual rate of decline in this quarter in the 30 to 40% range. I'll show you some stuff later. Congressional Budget Office on the NABI looking for those magnitudes of declines. Unemployment rate in the teens. Look at what's happened on the energy side. Energy price collapse and partial rebound. We've got 50 different experiments going on now in terms of restrictions and reopenings. Watching that play out, of course, on the nightly news. Growing pressure to reopen. There was an interesting line in Barron's a couple of weeks ago, making the point that economic suicide is not normal behavior. And so people have been very frustrated, particularly in parts of the country where there seemed to be minimal impact or cases. Right, next. The carnage, you can reflect, and this just touches parts of this, but you think about this cycle and then what we've seen. Of course, obviously the human tragedy of well over 100,000 deaths, the unemployment, and the Federal Reserve had some data that came out late last week. Between February and May, the lowest quarter of wage earners, 35% of those jobs disappeared, because of the shutdowns we saw, a lot of it in the service sector, leisure, and hospitality. So the unemployment has been borne excessively by the lower income parts of the labor force. The financial losses of firms, and of course we've seen the volatility in the stock market. The net worth declined by over about $6.5 trillion in the first quarter for households and nonprofits. The disconnection and the fear that comes with the job disappearance, the stay-at-home kinds of orders. It's been interesting to look at, COVID has gotten all the attention, but the non-COVID medical issues, where lots of places have banned non-essential services. People have been afraid to go to hospitals. They've put off things, all kinds of financial problems for the hospitals as a result, and medical problems for individuals. The focus has been COVID, not the other stuff. And that, of course, is loosening up. You think about some of the different demographics. Retirees. I live around a lot of retirees. You have fear of the virus by virtue of their age structure, the volatility in the financial markets, the excitement about CD rates less than 0.5%. Pre-retirees, suppose you were going to pull the plug at 62 or 64, and you see the sharp decline in markets and the volatility. What do you do? Okay, millennials, they're getting hit again. In many cases, came into the labor force during the Great Recession. Now they're getting hit with low levels of seniority, with potential job loss again. New entrants. Now, most of us, we can work from home, but of course, a lot of people don't have that option, okay? And they've been hit disproportionately. Self-employed, who don't have corporate or state benefits and stuff to fall back on. Disrupted education. Yeah, we've shifted to online, and as some said, we probably have flunked that test, the rapidity with which that was done. Okay, next, I'm just touching the top of this. the viability of different business models. What's it going to be like? The ability of firms to withstand zero or reduced revenues. I mean, bankruptcy, pennies, J. Crew, Pier 1 liquidation, Neiman Marcus bankrupt, Hertz. I never made it to sweet tomatoes. Okay. And then on the other hand, you look at Amazon, Walmart, Home Depot, grocery stores, Costco, Zoom. Okay. They've thrived, but business models are having to change. The industrial impact. I mean, sure, travel, tourism gets a lot of attention. Look at us today. Okay. We're not in Portland doing this over the cyberspace. The fear of going out. You think about the word social distancing in commercial real estate. It's like an oxymoron. Okay. What are the implications of all of this and changes in behavior? Hospitals, plane makers. Your meeting was going to be in the Northwest, which has a great deal of aerospace activity. Look at what's happening. And I'm not just talking the 737, but orders, cancellations, colleges and universities. A lot of you are academics. What are they going to be like in the fall? What's happening to their ability to fund themselves with the empty dorms and that sort of thing? Sports, nonprofits, the list goes on and on. State and local governments with the balanced budget requirements, revenue impact, unfunded pension promises. That's not going to get a lot better. The squeeze and other things. And you think back to the last upturn coming out of the 2007 and 9 recession, look at the drag that you got from government because of revenue issues. The global poverty issues. We had a lockdown here. So did Bangladesh and Pakistan and India. Dramatic increases in global poverty as a result of this situation. Next. This comes from Bureau of Labor Statistics and Arizona State University, Seidman Center. I like to use this. Comes out every month. You track the year-over-year gains by state. And if I'd had as much time as I thought I was going to have at the start, I was going to go into some of the geography or where you were from, but didn't have time for that, and in a sense, don't have to. In April, all 50 states were down. I've never seen that before. Okay, you go back to January or February, 4 or 5 states were down, largely energy related. But now all 50 states have declining employment. Utah's doing the best. Michigan's doing the worst. So it's remarkable. Okay, next. Michigan in April down almost 23% year over year. Vermont 22. New York. Utah is doing the best. They were only down 7.11%. The highest unemployment rates, Nevada, which if you think about it, makes a lot of sense, given the casinos were shut down. Then Michigan, Hawaii with its tourist dependency. The lowest was Connecticut at 7.9. Variety of death rate experiences across the country. You get a sense of the differences in the experiences that we're having. Personal income shot up in April because transfer payments. Spending went down, savings soared. And again, minimal price pressures. Next. What's the end game of this? Okay, the relaxation of the restrictions, it's happening, the reopening. It's very likely the recovery will start in the third quarter. We had the peak of the last business cycle was in February. So in essence, the first full month of the recession becomes March. The expectation, most forecasters think it'll turn positive in the third quarter, but there's still obviously going to be a long way to go. There's a risk of a second wave, reimposing shutdowns. If we were in Portland today, the governor on Friday put a pause on the reopening. And you've seen data about increases in cases around the country. The question becomes, what's going to be left? How is it going to be changed? Will businesses permanently close? Will they restart? Or will it be a startup, a new one? Okay. Will there be a development of the vaccine? When's that going to happen? That can change behavior, obviously. What we're talking about is people's behavior in all the hats that we wear. Consumers, investors, entrepreneurs, business owners, employees. How is this thing going to change us? Next. Just sort of some observations, thinking about this, okay? If you look back after the Depression of the 1930s, and I don't remember this, I read about it, in the Great Recession, you had increased savings. People had more fear, they increased their savings, slowed their consumer spending. That's likely going to be an outcome of this. Think about how we've changed our behavior, like the online shopping. I mean, Amazon was growing rapidly anyway, but this gave it an additional boost, put pressure on bricks and mortar retailers. All this time around the house, how will it change us? One of my favorite lines is, we come out of this thing chefs or alcoholics, having spent so much time at home. But what will last? The remote work and virtual meetings. How much will go back? A lot of you have probably had the experience, you're on boards, that sort of thing, that go to meetings via Zoom or GoToMeeting or Connect. How much is going to go back when you realize, gee, this works out pretty well, and so many people can work from home? Do we need this office space? Are we going to have to go back as much to in-person meetings? That's got, of course, huge implications for the hotel, restaurant business, that sort of thing. Supply chains. We probably didn't think, in many cases, a lot about supply chains. We had a globalized world. Now, location's going to be a little bit more important. We may tend to have more inventory. We went through years reducing inventories, getting us down to just in time was a cost reduction activity. Now we may shift a little back or a little more to a just in case. Regional networks, paying attention to alternatives. Okay, when we suddenly realized the supplies of ingredients for medicines came from China, or masks, that sort of thing, starting to look at developing alternatives, maybe more protectionist policies. I mean, stockpiles are not a sexy thing to spend money on until you need the stuff. Okay. Well, we've seen that. It's going to be fascinating to look at the geographic implications of this event. We've pushed density, public transit. Some of those things may have played a role. In the spread of the virus. With the experience on remote activity, will we see people doing more for some of the smaller metropolitan areas, lower cost metropolitan areas? There's a debate going on then now, some saying, oh no, it'll still be the big cities. Others saying, we're not so sure about that. Next one. All of a sudden, we're paying a lot more attention to digital access. When we say, okay, we're going to have online learning, but everybody doesn't have that access, particularly low income, different households. There'll be a lot more emphasis on expanding that and increasing the quality. How long for people to emerge from this trauma? The fear of going out, going to work, crowds, movies, trips. And how long is that going to take? It's partly, of course, it's going to depend on development of vaccines and treatments. Now, I noticed some of the, a lot of your research topics. I mean, you pay attention to the medical system and the medical insurance. And of course, we know that the medical insurance tied to employment was a legacy of the Second World War. And we repealed the mandate to have that was in the original Obamacare legislation. What are we going to do to that safety net? I mean, when you have people, millions of people losing jobs, impacting their ability to have medical insurance. What are we going to do about that safety net? The telemedicine. I mean, I have ads now in our local paper. You can get telemed appointments with doctors. Well, you didn't see that before. Now, all of a sudden, that's a way to enhance the ability to provide the service, change compensation. Paid sick leave, get a lot more attention if people are sick. They don't have paid sick leave, they go to work, you order people to stay home. Of course, a major income impact. And as many of you know, debt burdens with forbearance, deferred payments, debt burdens are changing. The debt isn't going away, it's being deferred. You got lump sum payments, Kurt, that will occur. How is that going to play out? And you've got people say, well, I don't have to pay my rent and I can't get evicted, but the landlord still has to make the mortgage payment. You can see how that ripples through the system. You probably are familiar with modern monetary theory. Modern monetary theory, which says, in essence, don't worry about the deficit. We're borrowing in our own currency. Use fiscal policy, and then we'll tighten when inflationary pressure emerges. We're doing that. Okay, we've got an experiment underway. As I was putting this together, I kept thinking about Joseph Schumpeter and the notion of creative destruction. New stuff comes along, driven by technology, and now driven by nature and government edict. It's going to change the way we live. There's going to be a lot of churn. Last slide. Okay, think about the outlook. Okay, next. Okay, second quarter, it's going to be terrible. Okay, Congressional Budget Office says this year output's going to go down a little under 6%. Second quarter, annual rate of almost 40%, but rebounding in the third. And rebounding next year, not fully recovered, but rebounding. Next, National Association of Business Economists, down 33.5% annual rate in the second quarter. You can see the notion, this dramatic decline, continued low inflation. Next. It's fashionable to talk about letters, a V-shaped recovery, U, W, which is the double dip, swoosh, since you were going to be in Portland, that's the Nike emblem. Okay. And that probably is the most likely, but we don't know. This is the radical uncertainty part. I think the recovery will start, very likely start in the third quarter, but the nature of it, we don't know. Next. There are glimmers of rebound now. You look at TSA accounts at airports, occupancy rates at hotels, continuing claims, driving data, auto sales, toilet paper availability, the May employment, okay? There's a lot of things you can point to that suggest that things are in the process of turning. Next. But really, the virus and the response are going to call the tune. As in Oregon, you've got a pause in the reopening. If we see more of that, that could slow this rebound. We just don't know. That's why I talked about the radical uncertainty. And the last point, there will be no shortage of topics for LIRA 73. Thank you very much for your attention. And I'm sorry I went 6 minutes long. Well, thank you, and Hope you have a good conference.
John, I'm just going to end and thank you for your comments. You provided great insight today, both in terms of sort of what we think intuitively and of what I think we know, but giving us a little bit of the data in the background. I guess Emily and Bernadette, I just want to confirm that we're at the end of the session, and so folks should now start considering their concurrent sessions that they'll be attending next.
We are. However, if John would like to address anyone in the chat, we can make sure that that's posted on the discussion board, or there's nothing else in this plenary session. So if you're not headed to another session, I need to pop off to help them, but you're welcome to stay here and answer questions if you'd like.
Okay. So John, if you have like maybe 2 minutes and we'll
Sure.
We'll invite, if anybody wants to open up their mic and ask John a question. Got a couple minutes before the next session starts, so the floor is open.
Okay, now I've got.
Okay, so it looks like you've answered all the questions that folks had, so which is of course not at all surprising. And I can see in the chat, folks are definitely, I don't know if you can see those that chat dialogue as well. The folks definitely appreciated what you had to share today. So
Okay, thanks, my pleasure.
I think we're great. John, thank you again. Look forward to catching up with you at some point. I'm confident that our paths will cross again in no short order.
All right, thanks, Tony.
Take care. I'm gonna leave the session, so I'm gonna guess you'll do the same. And folks,
I will.
maybe I'll see other folks in other concurrent sessions. Take care.
Thanks.